When most people start selling covered calls, I think they get the idea that having your shares called away from you is something that you want to avoid. And that might be true in some cases, but if you set up your covered calls properly, then getting called out can actually be a good thing. And you can experience incredible returns while getting called out consistently. So today we're going to talk about why that's the case, and I'll show you how you should set up your covered calls in order to fully take advantage of that idea. So let's get into it. My name is Charlie, and on this channel I make videos about building wealth and achieving financial freedom so that you can free up your time to focus on the things that you truly care about. Now, if you need a refresher on how covered calls work and what it actually means to get called out, I'd recommend first checking out my covered call basics video and then coming back here. But in a nutshell, getting called out on a covered call just means that your stock ends up above the strike price of the call you sold at the time the call expires. So you then have to sell your shares at the strike price, regardless of what price the shares are currently trading at. So for example, if you sell a covered call on a stock at the $102 strike price, and the stock ends up at $105 per share by the time the call expires, you still have to sell your shares at $102, which means that in that case, you've technically missed out on a bit of the upside in that stock. So in theory, that's really the only situation where covered calls seem less than ideal, but let me explain why it's not actually a bad thing to get called out, and why you certainly shouldn't buy back your calls in order to avoid getting called out, which some people like to do. And to explain this, let's start with a pretty typical example. Let's say you buy 100 shares of stock XYZ at $100 per share, then sell the 102 strike call 1 week out for a premium of $150. But then over that next week, stock XYZ runs all the way up to $105 per share. So at the end of the week, you have to sell your shares at $102, which brings your total profit to $350 for that 1 week trade, which is a 3.5% return. So you could look at that and say,
well, if I hadn't sold a covered call, my stock would be worth $105 per share right now, so I could have done even better.
Or you could look at it and say, well, I just brought in a 3.5% return in a 1 week trade. And can you really complain about that? There's a saying about the stock market that I really like, which says you'll never go broke taking a profit. So sure, you could have in theory made more money if you hadn't sold a covered call, but if you could replicate that 3.5% return every single week, you would do very well over time. Plus, saying that you could have done better if you hadn't sold a covered call is also assuming that you would have sold the stock at the right time. For all you know, you might have sold before it even hit $105 per share, or you might have held the stock for too long thinking it was going to keep rising and then it quickly dropped back down, and all of a sudden you would have been better off just selling a covered call. Either way, the point is that there are just no guarantees when you're relying on the growth of the stock alone, but when you're selling covered calls, you're guaranteeing yourself income every single week, regardless of what happens with the stock. So in my opinion, and in my experience selling covered calls, you're much better off just accepting the fact that you're going to get called out and not getting greedy with it. Because again, the main advantage of covered calls is that they provide you with guaranteed income every single week. It's very rare that a stock rises 5% or more within a single week, but with covered calls, you can essentially guarantee yourself a 1 to 2% weekly return without having to hope for a big movement in the stock. Now with that said though, I'm not saying that you shouldn't do anything to account for the gains that you might miss out on. There are definitely ways that you can set up your covered calls more optimally to further take advantage of stocks that are rising quickly. So let's talk about that. And I'll first just say that one thing you don't want to do is sell covered calls on stocks that are neutral trending or downward trending. And I'll often see people do this because they're afraid to miss out on gains by selling covered calls on stocks that are rising. But in my opinion, that's completely the wrong way to think about it, and hopefully you're starting to see why I think so. For me, capital gains are an equal, if not bigger, contributor to my overall returns than my premiums are. So if you're not trading stocks that are in a strong upward trend, you're leaving a lot of money on the table. So with that said, how do I actually make up for the gains that I might be missing out on? Well, there are 4 basic tactics that I use. The first and most obvious being just to simply sell calls further out of the money. So you may bring in a slightly smaller premium this way, but you leave yourself with more potential to bring in capital gains. And of course, this works best on stocks that you're very bullish on, and maybe stocks that are a little more volatile where you don't want to limit your upside too much. Then the second tactic I use is to sell shorter dated calls just about 1 or 2 weeks out in in time. And again, you only want to do this on stocks that you're very bullish on, because when stocks are more neutral, I do prefer to sell slightly longer dated calls to lock in a bigger premium. But with these shorter dated calls, you not only bring in more total premium over time because you're taking advantage of the very quick time decay that occurs in the last week before an option expires, but you're also preventing yourself from missing out on as many gains when a stock makes a quick, unexpected move. Because let's say you sell a 4-week covered call on a stock, then that stock jumps a few days later past the strike price of your call. At that point, you've already reached your maximum profit on that trade, and you don't get to take part in any of the additional rise in that stock if it does continue to rise. But if you had instead sold a 1-week call initially, you'll be able to get out of that trade sooner, still having achieved your maximum profit, and set up a new trade that very next week. Now, the next tactic I use is to buy extra shares on the side, and this is actually something I do every single time I sell a covered call. So when I buy a new stock, I'll buy anywhere from about 120 to 150 shares of the stock, rather than just the 100 required for the covered call. That way I have some extra peace of mind knowing that if the stock does rise quickly and exceeds my strike price, I'm still participating in some of that rise. Then finally, the last tactic I use is to supplement my covered calls with other trades on the same stock, namely buying leaps options, which I have made a video about in case you're not familiar with those, so I'll leave that linked below. But essentially, leaps options are just longer dated options that expire in 1 year or longer. So often when I sell a covered call, I'll simultaneously buy a leaps call option on that same stock. So this basically serves the same purpose as buying shares on the side, but it requires a lot less capital. Now keep in mind, buying leaps options is slightly riskier than buying the shares outright, so I do recommend that you check out my video about leaps options for a further explanation on how I like to utilize them. But they're a great way to ensure that you still participate in the rise of a stock even after you sold a call against it. And if you haven't seen my full video where I talk about how I pick stocks for covered calls, be sure to click that video in the bottom right corner of the screen so that you can achieve the best possible returns as a covered call writer. I'll talk to you all in that next video.